Most crypto investors lose money because they don't have a plan for what comes next. So it's about time to get ready and build one for 2026. Bitcoin is driven by liquidity, interest rates, and long-term technicals. And several of those signals are aligning right now. By the end of this video, you'll know exactly which indicators actually matter, how to read them in real time, and whether the data points support a Bitcoin bear market for 2026. All so you can position your portfolio accordingly. I'm Markus Lutz and I've been investing in cryptocurrencies for over 5 years and consistently outperforming the market since then. Now I'm helping others to do the same through strategic crypto investing. My first prediction for 2026 is that Bitcoin is likely to underperform versus traditional assets like stocks or other risk-on assets. Historically, crypto doesn't perform well during times of economic uncertainty. In these environments, capital tends to move away from high volatility assets and towards areas perceived as safer and more stable. Bitcoin may be a long-term store of value, but in the short to medium term, it still behaves like a huge risk-on asset. Global liquidity conditions are no longer improving. Many major central banks have either paused or actually ended their rate-cutting cycles. We have seen this with the People's Bank of China, the European Central Bank, and the Bank of England. At the same time, US unemployment has been slowly rising while inflation remains stubbornly high and above target levels. Even though the Federal Reserve has just recently cut their rates by 25 basis points, but the tone of that meeting was notably hawkish. The Fed signaled fewer rates ahead, especially into 2026 and 2027. In other words, monetary conditions may not ease as much as they previously hoped. There also has been a temporary expansion of the Fed's balance sheet through targeted liquidity measures and security purchases. However, history has shown that temporary QE is often not enough to sustain a broad risk-on environment, especially if the underlying economic data doesn't support it. This is where crypto comes particularly vulnerable. Historically, Bitcoin and the broader crypto market tend to signal economic stress before traditional markets do. A clear example of this was in 2021. Bitcoin peaked and began declining in November of that year, while equities didn't officially start their correction until January of 2022, so roughly 2 months later. Crypto was the early warning signal. Might this be the same case today? Now, when we combine these macro factors with technical evidence, the risk becomes more apparent. Bitcoin has experienced a trend change on the higher time frames, especially prevalent on the weekly chart, where it for the first time during this entire bull market broke the weekly 50 MA that has previously acted as very good bull market support. Historically, this meant losing this level during uncertain macro conditions increases the probability of continued downside. So when you put all of this together, tightening or stagnant liquidity, slowing economic momentum, cautious central banks, and weakening technical structure, the conclusion is fairly straightforward. Unless economic conditions meaningfully improve into 2026, Bitcoin is likely to underperform. We could see it lag behind traditional markets and continue behaving as a risk asset in a risk-averse environment. That doesn't mean though that Bitcoin is dead or that long-term thesis isn't valid anymore. But it does mean that expectations need to be adjusted for the upcoming year and your portfolio positioning needs to be more defensive until the macro picture changes. If this correction continues, this presents actually great dollar cost averaging opportunities. So you should be happy that the market is falling because it gives you better prices to enter. So right now, it is a great time to get prepared and invested in crypto for the years ahead. My second prediction is that now is not the time to get excited about altcoins. Altcoins only perform well when Bitcoin is strong and is in a sustained uptrend. When Bitcoin struggles, chops, or underperforms, altcoins don't just follow. They usually underperform even more. They have higher volatility, less liquidity, and significantly higher downside risk during uncertain market conditions. If Bitcoin continues to face pressure or lags behind traditional assets, allocating heavily into altcoins is a mistake, because it becomes a low probability trade. In these environments, capital preservation matters more than chasing any potential upside. Historically, the relationship is very clear. During periods where Bitcoin is trending lower or failing to reclaim key technical levels, altcoins tend to experience deeper drawdowns. What might be a 20% move down in Bitcoin often turns into a 40 to 60% drawdown for many altcoins. That's why, from a portfolio perspective, the default stance in this type of market should be defensive. If Bitcoin is not healthy, altcoins are not healthy either. The Bitcoin dominance chart is a great representation of this. The only exception to this rule is highly selective positioning at major support levels, but even then only with a clearly defined invalidation. That means knowing exactly where you're wrong before entering the trade. No long-term holds, no hype-based investing, just precise risk-managed setups. Without that level of discipline, altcoins become pure speculative bets, especially during these market conditions. Until Bitcoin establishes a clear trend reversal, regains key moving averages, and macro conditions improve, the risk to reward setup for altcoins just isn't there. They will continue to take their direction from Bitcoin, and historically they fall harder and faster when Bitcoin weakens. So for now, patience is the strategy. Staying mostly out of altcoins, preserving capital, and waiting for stronger confirmation is often the smarter move. My third prediction for 2026 is that stablecoins will reach new all-time highs and emerge as the dominant trend in crypto over the next coming years. I personally see the total stablecoin market cap potentially hitting $3 trillion by 2030, which is roughly a 10x increase from the current market cap today. And stablecoins are really becoming the backbone of the crypto ecosystem. One reason is the regulatory focus in the US, including efforts like the Genius Act or the Clarity Act, which specifically recognizes stablecoins as compliant means of payment. This regulatory clarity deems them as safe and an on-chain alternative for transactions and trading. Another factor is the rise of prediction markets and other on-chain applications. Platforms like Polymarket are gaining popularity massively, and stablecoins are the primary currency used in these markets. Increased usage in real-world crypto application is only going to accelerate the demand even further. From a portfolio perspective, stablecoins are also extremely practical in the current market environment. Across decentralized finance, you can earn yields as high as 8%, providing both passive income and capital efficiency. In a market where Bitcoin and altcoins are struggling, stablecoins allow you to earn yield while maintaining safety and waiting for better market conditions. Holding cash in stablecoins isn't just about earning yield. It's about keeping dry powder for opportunities when the market crashes. When everyone is fearful, you should be able to buy into the market and capitalize on this opportunity. Because remember, high quality assets with falling prices actually is just a discount for you to enter. So while most of the crypto market is facing uncertainty in 2026, stablecoins offer a safer, yield-generating, and strategically flexible option. They're likely to be the dominant narrative in crypto over the next coming years, both as a store of value and as a vehicle for active participation in DeFi and on-chain markets. So, where does this leave us? First, if you've recently cashed out profits, well done. The first rule of crypto investing is really to take profits during euphoria and protecting gains before the market turns. Second, consider starting mild dollar cost average purchases of Bitcoin, even if the market is uncertain. Building a position gradually allows you to take advantage of potential long-term upside while managing risk. Third, stay away from altcoins for the moment. Altcoins tend to follow Bitcoin and usually drop even more when Bitcoin drops. The only exception is if you're trading selectively at key support levels with tight stop losses. Discipline is critical here. By following these steps, protecting profits, gradually accumulating Bitcoin, and avoiding risky altcoins, you position yourself structurally sound for 2026, no matter how the market unfolds. Remember, patience and discipline are just as important as picking the right assets. Right now, it's about preserving capital, earning yield, and building a solid portfolio foundation for future opportunities. If you've enjoyed that video, subscribe and hit a like, and send this video to a friend who should hear this message. Thanks for joining. See you in the next video.